Hey guys, investment advisor Jeff Kim here. Wanted to make a video about my most recent mailing campaign I just sent out regarding deferring capital gains taxes, different strategies besides the 1031 exchange. On my postcard, I had actually said that I had 7 additional viable strategies besides the 1031. It's actually not specifically 7. It could actually be a little bit more. In some cases, less. So I think a common theme that you guys will probably notice in my videos is that I always say that there's no one size fits all solution for everybody, and that's a part of the conversation I've been having a lot this week when clients called me and wanted to know, well, what are the 7 ways? And I said, well, there are 7 ways. There's actually, in some cases, more than 7 ways, but it really depends a lot on your situation. When disposing of a property, I recommend doing a little bit of pre planning. I got some calls this week from people who were already in escrow, were days away from closing. One client who actually had already sold a property 6 months prior and wanted to know what they could do to defer their capital gains. And unfortunately, once you've already, once that money has hit your bank account, there's really nothing you can do in terms of deferring that capital gain. So the planning has to be done ahead of time. But just some of these strategies that I did want to talk to you guys about is, first off, I wanted to mention that it really has to do with your individual income and expenses for the year. At the end of the day, clients forget that it's not just all about your active income versus your real estate income. It's actually all lumped together. So in total, it depends what your income looks like for the year, as well as expenses, any potential losses you may have. But just to list off a few additional strategies. There's the reverse exchange, there's seller financing, there's exchanging into single tenant net leased investments, or DSTs, which is an acronym for Delaware Statutory Trust. There's improving other properties, capital expenditures to not pay those taxes. I've heard of some really unique strategies recently with charitable contributions. There's making the residence, if it's a multifamily, making it a primary residence. There's a step-up tax basis. So I think I've named 7. There's actually a few more strategies, but like I said, 7 felt like the good number. Where if I just said there's a few other strategies, I think people would have just not been too interested. If I said there were, many strategies, I think clients may have thought that that was just an exaggeration, but there are definitely strategies. But I think a big part of it is planning ahead of time and figuring out what you're going to do besides actually making the sale and then trying to do it. So hopefully that helps. And if that brings about any questions, if you'd like to talk about your individual situation, feel free to give me a call. We can talk about what we can do. With that said, my disclaimer: I'm not an accountant, I'm not a tax advisor, I'm not a financial planner, wealth advisor, yada yada, so on and so forth. I'm an investment advisor, and a lot of these strategies I've just learned from experience. And part of what I really enjoy about working with investment clients is that as much as I can advise my clients, I'm actually learning new strategies from clients that I've worked with all the time. So just sharing the information that I've learned over the years. I guess that's it for now. I'm going to sign off. Jeff Kim, investment advisor. Feel free to contact me, email me if you have any questions. Bye for now.